let me explain in the next 60 seconds what happened to markets today. The S&P was down 1.5%, similar declines for the Russell. The Dow was down about 1%, but the Nasdaq down about 2.5%. Okay, you might laugh at this, but it was because retail sales came in stronger than expected. You were revised up from last month 0.4% all the way up to 0.8%. So that doubled from last month as per what we had expected. And you still beat on a month-over-month comparison looking at last month and came in at 0.4%. The estimate was 0.3%. Now, for the Fed meeting of December 18th, there's almost a 50-50 chance of a 25 basis point cut versus no cut and a pause. But let me tell you right now, I give a rat's ass about whether the Fed cuts December 18th or not. Think about it like this. The Fed has cut rates 75 basis points, but 10-year Treasury yields have moved up almost 75 basis points. So really, the Fed cutting has added more restriction to the economy and or our markets. And the only thing that really matters in the grand scheme of things, if you are an investor, is how is the economy doing? If the economy does well, stocks will do well. After all, it's a good problem to have if the Fed does not need to cut rates as much as expected. And I think markets have since lost sight of that, especially on a day like today. Consider what Fed Goolsbee said today. He says the Fed has to figure out why the 10-year is rising and keep an eye on long rates. The Fed's basically saying, this shouldn't be happening right now. We don't want this to be happening at the Fed. We want to add accommodation to the economy, not restrict the economy even more. Midwest Advisors LLC says, here's your answer. And this is the answer. Inflation expectations are moving higher. This really is calculated in bond markets. Now the expected inflation longer term is 2.78%. That is what is causing 10-year Treasury yields, the really entire long end of the yield curve, to go higher. This is not accurate, okay? In the more medium term, the next 6 to 12 months, I think that's a medium term outlook, you're going to see inflation expectations proven wrong. I don't think Trump is going to cause inflation, okay? Whoever created this fallacy is, let's be respectful here. I was going to say something not so respectful, but delusional, or in Delulu land, as I like to call it. Something about cutting government spending does not spell inflationary pressures to me. I don't know. I wasn't the greatest in algebra and advanced math classes, so perhaps you guys could let me know. Government spending being reduced, does that equate to more or less inflation? Let me just save you the hassle. All inflation is government spending. As the late Milton Friedman once said, consumers have always spent all of their money, which is prevalent in the consumer personal savings rate. Companies have always been greedy. They've always tried to have the best margins possible. The only variable that ever changes is government spending. Now, if we can assume under a Trump presidency, there would be less government spending opposed to more, which I think is reasonable, that would equate to lower inflation. So I actually think in terms of an upside catalyst for markets, it is most likely some accommodation coming back into the real economy when 10-year Treasury yields do fall, as we realize, hey, there's not going to be higher inflation. In fact, take a look at one of the top articles from CNBC yesterday. It's actually a breakdown of deflation for October 2024 in one chart. You have Turkey down 3.9% year over year. You have basically most of your food categories in deflation territory. Energy down 5%, gasoline down 12.4%, but all items less food and energy. Telephone hardware Calculators down almost 10%. Dishes down 7.4%. Cars and truck rentals down 7%. Men's suits, sports coats, and outerwear down 6%. Computers down 5.4%. Televisions down 4.5%. Toys, games, hobbies, and playground equipment down almost 4%. Bicycles down 3.6%. Used cars and trucks down 3.4%. Clocks, lamps, and decorator items down 3.2%. Window and floor coverings down 3%. Sewing machines, fabric, and supplies down 3%. And there's others here as well. We're actually seeing deflation, which, careful what you wish for, because deflation is actually worse for the economy than inflation. So something is not right here, okay? Either the economy is weaker than the data suggests, or we are about to see deeper deflation, which could push the economy into a more weak place. Now, with that said, the Nasdaq's down about 2.6% today. There are some important technicals that we will look at in just a moment, but if you look at the daily candlestick chart for the Nasdaq, today was a bit of a gap down, and this is now the 5th red day in a row for the Nasdaq, which has not happened in years. Some people are saying this is an omen for further downside in the Nasdaq, and perhaps that could be true. Okay, there is a pretty clear technical wedge that should be respected, especially at the downside level. Once you get to about 494, only $1 downside from here, you're going to be sitting right at that lower end of the wedge. If you break that to the downside, you're looking at more downside for markets. But again, I do think it's important to circle back to what's happening right now in markets and why markets are selling off. Well, really, the main thing is a slightly more hawkish Fed, okay? But they're being hawkish because the economy looks like it's doing better. So that's actually bullish for markets. Now, I've said on this channel for a while now, I'm actually not bullish on the indexes. I'm actually not bullish on the SPY or the Nasdaq. I think they could come down. But I think in a more logical scenario with lower inflation, higher economic growth, perhaps less cuts from the Fed if the economy is strong and we have a soft landing, which I don't think is guaranteed until probably midpoint next year. We won't know for certain whether we're going to have a soft landing or not. Keep that in mind. But less regulation, all of the Trump policies that could be beneficial to the business cycle, like lower corporate tax rates, all of that is going to benefit the internals of the markets more than it will big tech. Big tech is expensive, it's pricey, there's not a lot of upside left there in my personal opinion, and that's why I'm not as bullish on the headline S&P or the Nasdaq, because they're basically just a proxy for big tech at this point, considering about 40% of those indexes is the top 6 or 7 names in markets. And I firmly think the next probably couple of years are going to be a stock pickers market, which, unless you're just all in on index funds, that's going to be good for your portfolio. So I'm forced to be bullish on markets from that standpoint, but not as bullish on markets as far as the headline index, because I'm not bullish on big tech. I don't think there's much upside left in those areas, and those areas control the indexes. But again, with a stronger economy, less regulation or deregulation, as we call it, assuming tariffs are not as bad as we think or the markets think they could be, lower corporate tax rates and stronger economy, that is directly going to favor small caps and mid caps, industrials and cyclicals. You will likely see at some point big tech sell off and the rest of the markets rally higher. That is my expectation in 2025 if we have a soft landing. Now, if we have a recession, again, we won't know if we are going to have a recession until we get at least 3, 4, 5 more months of economic data coming out. Then everything's going to sell off in the hard landing scenario. I mean, let's face it. The reason why Mag 7 has outperformed in recent years is all of the opposite reasons why the rest of the markets could outperform in 2025. If we, well, a lot of the earnings growth was really concentrated in Mag 7. That should expand, right, as the comps are a lot easier comparing to 2022 or 2023 for the rest of the markets. Inflation was high, so there was a risk of a recession. If that starts to go away, then the whole reason you'd want to own Mag 7 kind of goes away at the same time. Now, this is more for the medium-term outlook. This is more for the next 6 to 12 months or so. In the very near term, I talked about this in prior videos, but we were overdue for some consolidation, and that's what this seems like to me. The VIX, take this as an example. I called out the VIX in the last 2 days, okay, that the VIX was getting a little bit complacent, okay? You went from 23 before the election, which is very high. That's like very fearful. Almost everyone has a put or two in their portfolio at that point. Down to under 14 at one point on November 13th. Well, at that point, you're sitting at kind of where we had been throughout all of 2024. That's like an average VIX for all of 2024. We are in a higher risk environment. If you want to think about the Fed, if you want to think about a new administration, different policies, potential tariffs, if you want to think about, again, inflation and what's going to happen with the economy, right? We are in a higher risk environment. That is factual. And the VIX was trading at the levels that it traded at when we were not in a higher risk environment. Okay, again, throughout all of 2024, that was kind of the median level on the VIX, around 14 or so. Well, to account for the higher risk environment, you should see the VIX higher. And that's what happened today. The VIX is up 21% to 17.3. That, I think, makes more sense. That is higher than almost every point you've seen in 2024, minus the period in April. And I think that makes sense, right? This is pretty appropriate given the higher risk environment. It wouldn't surprise me if the VIX actually goes up a little bit more. Now, part of the reason, despite the Fed being a little bit more on the hawkish side yesterday and odds of a Fed rate cut for December 18th falling almost to about 50%. It's basically a toss-up whether we get a rate cut December 18th or not. Keep in mind, we have a bunch of other data coming out. A whole new set of basically all of your economic data coming out between now and December 18th. But another big kind of scare factor today is a new potential trade war with China. Yes, the reality is setting in that if we put on tariffs, China may put on tariffs. Now, you have to think about this from two different perspectives. You got to think about, in the short term, what kind of fear this could cause to markets. And you actually have to think about this in the actual sense of, will these things be enacted? Okay, this will give you a better judgment to the medium term, the next 6 to 12 months, what's going to happen to markets. Let's face it, if there is a broad swath of tariffs put on China, China will put a broad swath of tariffs on the US. That is not good for the economy. Whether you like Trump or not, he measures his success based on the economy and based on the stock market. Trump is not going to enact policies that are, one, bad for the economy, or two, bad for the stock market. So, just like you've seen in 2018, there's precedents for this. Trump was threatening a trade war with China. And what happened? Stocks sold off 15-20% or so. And then we realized, oh yeah, they're actually not going to do any of that. And then right before Christmas, on Christmas Eve, actually, markets bottomed and started to recover. And you had a great post-Christmas rally. I think you can use the 2018 playbook with the last fear of a Trump trade war and apply this directly to what we could see. Okay, markets are going to get fearful over what could be, and we're going to realize it's not as bad as we think. That's why, if markets continue to sell off, if you do see disconnects in areas of our markets, that is a buying opportunity. If the fear is, of course, a trade war with China. Now, the only thing I really care about right now, because I think those are going to be very short-term in nature, the only thing I care about from more of a long-term perspective, the next 12, 24, 36 months, is how is the economy doing? If we go into a recession, then you're looking at potentially years of downish sideways-ish markets, not just for the index, but for average stocks as well. Like in the bullish scenario, I think the indexes could go up 5% next year, because I don't think big tech is going to outperform the way it has in many years. Even if you've seen big tech sell off and the rest of the markets go on meme stock like rallies, they're going to have a net effect, and the index is not going to move up that much. Okay. Obviously, there's variables depending on the severity of a Mag 7 sell off. Now, in a more doom and gloom scenario, you have a recession, and that causes everything to sell off for a long time. So in the near term, long story short, you're probably going to see more fear in markets based on a potential Trump tariff situation, trade war with China. Now, I don't know the timeline of that. I do think it's kind of overdone for today, overdone in the near term. It wouldn't surprise me if you get a bounce, but especially heading into inauguration, I see there's a good chance of more fear to come into markets. But am I concerned about this from the more medium term, longer term perspective? No, I'm not. I will get more concerned about that medium, longer term perspective if we start to slip into a more recessionary like environment. That's the only thing that I really care about as of right now. Again, from a short term perspective, yeah, you could see more fear, specifically a China trade war type fear. We already know the playbook to that. It already happened before. But, you know, if you're a longer term investor, that shouldn't even matter to you. Because again, we're not going to have a trade war with China that's bad for both of our economies, and I don't think anyone wants to see that happen. Now, we also looked at this in prior videos in recent days, but the AI investor sentiment survey that asked one question, it asked the survey respondents, where do you think the stock market will be in the next 6 months? It's one question. It's very simple. On November 13th, on Wednesday of this week, the bullish people were 49.8% bullish, which is almost a one-year high. The one-year high is 52.9% on the week ending December 20th, 2023. Okay. You are in a high-risk environment right now. You should probably not see the bullish percentage almost at a one-year high. Again, that's something I talked about in the last 2 days of a reason for a little concern in the short term. And look what happened. Markets sold off a bit. You have 21.8% of investors that are neutral and 28.3% that are bearish. Now, Tom Lee with Fundstrap writes on X, is market hawkishness nearing a local top? October retail sales, possible dovish turning point. This incremental hawkishness is evident in the one-year inflation forwards. The one-year measures inflation over the next year. 1 year from now, this has crept up from 2% in July to 2.72% recently. A 72 basis point rise is meaningful. And they're basically saying that maybe the markets have gotten ahead of themselves in anticipating higher inflation. And you've started to see this come down a bit in the last couple of days, and maybe it could come down further, which would be relatively bullish for markets. So again, just to be crystal clear, anything can happen in the short term. It wouldn't surprise me if the markets become more fearful about a potential trade war with China, especially when China starts to respond and give us maybe some kind of guidance of what their trade policies could look like under a Trump presidency if we do go down the route of a trade war. We've seen this happen in 2018 in December. I'll actually show you real quick what that looked like if you were not invested during that time. It was pretty ugly. This was the December 18th fall, or the December 2018 fall. Markets fell 20%. I mean, like, there's a possibility that you could see 10, 15% pretty easily, considering where valuations are, where markets are at. You're pretty stretched from a valuation perspective. I mean, that wouldn't surprise me in the near term. Do I think there's anything to actually worry about, though? No. Okay, so this would be a buying opportunity. Now, on the other hand, you do have big earnings coming out next week. You have Walmart Tuesday pre-market as well as Lowe's. Anything that gives you clarity into the consumer is important. In fact, in 2007, Walmart was one of the first companies to warn about the consumer slowing down, and that sent the markets down over 3% that day. And 6 months later, you were in a recession, right? So I will pay very close attention to Walmart earnings. I think they will tell us a lot. Now, it's really all about Nvidia coming next week, though. Let's not kid ourselves. The only issue I have with Nvidia right now, I think they're going to have good earnings. I think things are going to be fine. But when you look at Nvidia, even after today's selling, and really the last couple of days that have not been great for Nvidia, Nvidia is down 4%, you're still sitting at $141 per share. You're still sitting at the all-time high that you set June 20th, 2024. Like, I think there's still more room for downside in specifically Nvidia from that standpoint, and that makes me a little nervous. Although I think they're going to have good results heading into that earnings again on Wednesday. It wouldn't surprise me to get some profit taking perhaps on Monday and or on Tuesday. Now, if Nvidia does have good earnings, they impress again, then I think that's going to be risk on perhaps again for the broader market. I do think it is a great sign. Tesla stock is really doing well today, up over 2% when the broader markets are selling off. I think it lays credence to the idea that you could see markets come down, but not everything has to come down. Again, I think Mag 7 will likely come down, and you could see just a broader rotation into other areas of our markets. Now, if this turns out to be a 2018 Trump-China trade war again, then, well, last time that happened, we fell 20%. This time around, I think markets realize that's not going to happen, but you could still see 10-15% downside pretty easily. In that scenario, I think it would be hard for Tesla to do well, but I think it's going to relatively outperform the markets. Now, from a technical perspective, Tesla did hold support at this line I've had drawn on the charts for a while now. Hopefully, we get a bounce to the upside. As I explained as well throughout this video, if you do see Treasury yields come down, that can be a positive as well, especially for your more interest rate sensitive names. Tesla being pretty much the most interest rate sensitive stock that there is. So I think there's a lot of reasons to like Tesla here. I think there's a lot of reasons to be bearish here. There's reasons to be bullish here. I don't think anything is certain, and I think you should position yourself to win in any scenario. So if you're trading short term to the upside or the downside in money that you need, then I wouldn't do that. Think about like options, for an example, in terms of money you take to the casino. You don't take your money that's going to determine your long-term financial success. You don't pull out your portfolio and take that to the casino and put it on red or black, right? You just don't do that because that doesn't make a whole lot of sense, right? I wouldn't be doing the same thing in markets right now. I can tell you right now, CNBC is going to be dominated by bears. The bears are going to come out in full force after a day like today, and maybe for good reason. Who knows? At least in the short term. Longer term, the next 6-12 months, I don't think any of this is going to matter. I think the only thing that matters is the economy, and we got good news on the economy today, and I think ultimately everything will play out in due time. In the very short term, though, it wouldn't surprise me to see more fear come into markets, especially up until Wednesday when Nvidia reports earnings. I could definitely see some fear, some profit taking. Monday, perhaps even Tuesday, Nvidia was down over 4% today. So it does seem like the start of that already has started to happen. But, one stock's loss could be another stock's gain. And I think Tesla's in a very good position to continue to do well, especially, given today, Tesla's really a standout, up over 2%, whereas the broader markets had a very bad day. So let me know what you think about this information down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.